On April 9, 2026, the S&P 500 hit a significant technical wall at 6840, a level defined by a massive JPM call position. This ceiling coincided with a geopolitical reality check. Despite reports of a ceasefire, physical data through late Wednesday showed zero crude tankers transiting the Strait of Hormuz.
The S&P 500's attempt to extend its relief rally hit a major roadblock at the 6840 level. Nana notes that this price point is anchored by a massive JP Morgan call option wall, creating a hard technical ceiling. As the index approached it, market makers were forced to sell futures to hedge their exposure, which effectively capped the move. This technical friction coincides with a significant disconnect in energy logistics. While diplomatic headlines suggest Iran has reopened the Strait of Hormuz, physical tanker flows haven't normalized yet, remaining effectively at zero despite the ceasefire reports. While technical levels provided the initial ceiling, the macro data added fresh fundamental pressure. New reports from the BEA show real disposable personal income fell 0.45% in February. Eurodollar University highlights this decline as a primary headwind that helped snap the index's 7-day winning streak.
The software sector faced a structural shift today. Nana reports that the IGV software ETF is under heavy pressure as investors reprice the industry. The narrative is undergoing a regime shift. AI is moving from being a helper to a direct competitor. New agent models from Anthropic and Meta are now perceived as threats to traditional SaaS workflows, moving beyond simple assistants to autonomous executors.
To navigate this shift, Meta is moving deep into the physical layer. Nana reports the company committed an additional $21 billion to CoreWeave for AI infrastructure through 2032. This massive capital commitment signals a strategic preference for raw compute power over traditional software layers, as the industry's competitive advantage migrates toward the hardware required for execution.
There is a significant gap right now between the ceasefire headlines and the actual shipping data in the Middle East. Despite reports of a potential ceasefire, Macro Voices notes that zero crude oil tankers had transited the Strait of Hormuz as of late Wednesday. This physical standstill is keeping the risk premium on oil elevated as the market weighs headline optimism against the ground truth of energy logistics. To handle this uncertainty, Macro Voices suggests using asymmetric hedges. They're highlighting a 2026 crude oil bull call spread using the 100 and 120 strikes. This specific structure is meant to manage exposure if tensions re-escalate, allowing traders to trade the gap between diplomatic statements and the actual logistics on the ground. We're seeing real signs of consumer exhaustion starting to show up in both retail strategy and the hard data. Eurodollar University notes that Target is slashing prices on 3,000 items to try and jumpstart demand, which suggests a significant loss of pricing power. This isn't just an isolated case. According to Danielle DiMartino Guth, U.S. personal consumption growth slowed to 0.6% early this year, down sharply from the nearly 2% level we saw at the end of 2025. Turning to the labor market, the outlook is also becoming increasingly cautious. Danielle DiMartino Guth argues that April's non-farm payrolls risk printing negative, which would expose the artificial boosts seen in the March data. She points to seasonal and birth-death adjustments as factors that may have masked a fundamental weakening, suggesting the underlying economic reality is more fragile than recent headlines imply. Moving to the macro signals, the Fed is dealing with a tug-of-war between inflation and productivity. According to 42 Macro, February's PCE data hit a 3-month annualized rate of 4%, a sticky number that likely keeps the central bank in a hawkish stance for longer. However, there's a countersignal in corporate profits. A positive impulse in the fourth quarter supports the narrative of a productivity-led growth cycle, where earnings strength might be enough to offset the growing consumer weakness we've been tracking. Turning to structural risks, a new MIT study introduces the Iceberg Index to quantify hidden economic disruption. Economics Explained reports that this metric finds nearly 12% of total U.S. wage value is currently exposed to AI automation. To wrap things up, we're watching the 6840 level on the S&P 500, the software sector's structural shift, and the physical tanker lag in Hormuz. Moving to individual stocks, Everything Money anticipates a revenue drop for Qualcomm as Apple insources its chips, but the company's $45 billion automotive pipeline is a significant offset. We Study Billionaires also highlights Wise plc, citing its strategy of passing scale benefits to customers as a durable competitive moat in the fintech space. Looking to the week ahead, the market faces a key test. Will technical resistance at 6840 hold, or will fundamental weakness take the lead? We'll monitor both the S&P breakout attempt and Hormuz tanker flows for the next signal. A full source list is in the description. Subscribe for more high-signal recaps of the sessions ahead.